Bitcoin mining has changed drastically over the years, but today miners are facing a new kind of competition: the rise of AI hyperscalers. These massive data centers, fueled by the AI boom, are reshaping energy markets and forcing miners to adapt in ways we've never seen before. To help us unpack this, I'm joined by Fakhul Miah, Managing Director of GoMining Institutional and a former Morgan Stanley executive. We'll explore how AI is challenging Bitcoin mining, why miners are evolving into financial engineers, and what the growing institutional and sovereign adoption of Bitcoin signals about its future. Welcome to the Defiant Podcast. Hey everybody, and welcome back to the Defiant Podcast. I'm your host, Vinny, here with Fakhul Miah. Fakhul has been the managing director of GoMining Institutional, and before that was a Morgan Stanley executive. And so he's really adept at bridging the TradFi and DeFi worlds. Fakhul, thank you so much for being here.
Thank you for having me, Vin. It's a pleasure to join you and your viewers.
Yes, absolutely. And so we have a lot to talk about today, both with your expertise and also the fact that we have GoMining's H1 2025 Bitcoin mining market review, which unveils a lot of really interesting topics and trends. So very excited to jump into how AI is reshaping energy markets, Bitcoin mining's evolution, and what institutions and sovereign actors are signaling about Bitcoin's next stages. So let's jump right in.
So we are actually the largest retail platform globally for tokenized Bitcoin mining. What does that mean? Is we own Bitcoin mining data centers all around the world, and we tokenize the mining power from those data centers measured in hash rate in digital form and then sell them to retail users. So a retail user can come on our platform, get exposure to Bitcoin mining through a digital miner, earn Bitcoin and sell the miner. Super cool. That retail side's grown to, we just hit 4 million users. We just hit 10 exponential mining powers. I'm very proud.
Congratulations. That's amazing.
Thank you so much, Vinny. Thank you. And then on the institutional side, just based on pure demand, we launched GoMining Institutional for more sophisticated professional investors, where we have a number of different products. So yeah, definitely come and check out gomining.com or institutional.gomining.com. Lots to come, exciting things, definitely.
Looks like you can get both Bitcoin exposure and your PhD in Bitcoin mining.
Yeah,
together in one.
Our resident analyst, Nico Smith, who's very well known in the industry, he's phenomenal.
As technology evolves, so does the demand for energy. In the US, a new battle is unfolding over this scarce resource. On one side, Bitcoin miners, flexible, decentralized, and resilient. On the other, AI hyperscalers, massive, power-hungry, and backed by deep capital. This isn't just a competition for electricity. It's a clash of priorities. AI is seen as strategically critical, while Bitcoin mining still carries a reputation that varies across jurisdictions. But what does this mean for the future of mining? And how are miners adapting to this new reality? Let's explore. Fakhul, your report highlights how AI hyperscalers are rapidly pushing Bitcoin miners out of core US energy markets, which I think is a pretty substantial trend. Can you unpack what exactly is happening here?
Yeah, absolutely. So what we're seeing right now is in US power markets, essentially there's a battle for the scarce resource of electricity. And so on one hand, you have Bitcoin miners such as ourselves, Marathon, etc. And then you have kind of what I'd call the new kid on the block, the AI hyperscalers. And everyone knows AI now, it's exploded. And in the same vein, there's been a huge amount of investment, almost limitless, going into the AI sector. And so one of the key things when it comes to AI is that you need large scale, super power hungry data centers to basically power the models themselves. And so I refer to it as AI mining, just for reference. And so what we're seeing is that you have these AI hyperscalers and they're deploying capital at an unprecedented rate. They're pre-booking gigawatts through long-term contracts. They're taking up capacity. And in many instances, they're outbidding miners for space. And also, there's that perception gap because broadly speaking, policymakers view AI as strategically critical, whilst mining, despite it's becoming more accepted and its technical ability to stabilize grids, still carries some reputational baggage across jurisdictions. Having said that, it's not all bad news for miners. What does it actually mean? Really, Bitcoin mining can complement AI mining. And in the Bitcoin mining space, we actually also have some structural advantages compared to AI. So as an example, you don't require 100% uptime, which you need for AI. And that's actually quite critical. And because we don't need it, it actually makes us quite a flexible grid participant. We can turn off our machines if the local grid needs us to. It's otherwise known as curtailing. So it helps balance local grids, act as offtake, surplus energy. Also, another key point, without going too much in the weeds, is that when it comes to Bitcoin mining, we can mine in remote areas where AI cannot go. And so
Right.
our CapEx requirements tend to be much lower. So as an example, when it comes to AI, you have to be located next to a main hub. Because, if you think about it, when you're prompting ChatGPT, etc., you need instant, responses. So that's why that sort of mining tends to happen a lot closer. Whereas Bitcoin mining will go wherever we need to. Wherever there's power, we're there.
Yeah, that makes a lot of sense. And I like, as always, crypto being flexible and decentralized. So why is AI such a formidable competitor for energy resources? Is it purely about capital, or are there other dynamics here at play?
Good question. So there's two components. One is you'd be surprised by the sheer amount of computational power needed to power AI data centers. Because if you think about it, think about when you're speaking to ChatGPT, Claude, Grok, etc. At some point, it would have had to have indexed a ton of information. It's constantly updating. It needs to find you real-time answers, and it has to always be uptime. And it uses like very specific types of chips that are somewhat, there's only so much supply, and Nvidia provides the batch of them. And so on that side, it's hyper expensive, but also in terms of the data centers required. So typically with data centers, you have different tiers. So you have tier 1, tier 2, tier 3, and tier 4, with like 4 being the best, 1 being the most basic. With regards to Bitcoin mining, we can do it with tier 1 and tier 2 data centers. And so our CapEx, so our initial capital expenditure, would be relatively low compared to an AI data center, which requires tier 3 and 4. So there's a huge amount more upfront capital that they need to put in. But on the flip side, they can generate, greater revenue in terms of like returns. Whilst Bitcoin mining, continues to still be profitable, it won't be as high. And so there's kind of this, balancing act. And then also, like with any new technology, there's a lot of hype around AI and opportunity. So, there's been many, many participants entering the space, jumping on the bandwagon, generating yield bets. Some argue that it's become somewhat saturated, and maybe there's too much capital in the space right now, and there won't be as many winners. So yeah, that's kind of why AI tends to be a lot more expensive versus, say, Bitcoin mining.
So I'm hearing there's a bit of a power struggle going on between Bitcoin miners and AI. So what does this power struggle mean for the future of Bitcoin mining? Could it possibly force miners to rethink their business model, do you think?
Yeah, so we've actually seen that. You could argue it's a power struggle, but I think just like any resource, there's always going to be a demand. And in some instances, they can complement one another. So as an example, you have traditional like pure miners, such as say Core Scientific, where they completely pivoted their business model to become an AI hyperscaler. That's one example. You have other examples, say, such as Marathon, where they kind of paused expanding on new data centers because of what was happening in the AI space. Now, on the flip side, it isn't necessarily that, whatever, data center that a miner is going for, the AI hyperscaler is going for also, and vice versa, because generally, you need different types of data centers, and the location is important. It's just more that, what historically would have been like a data center for very specific uses has become more varied. And so it's a case of, well, okay, imagine if all the data centers have been populated, the data center builders or producers, what are they going to build next? And excuse me, right now it's, on the AI side, we do still see Bitcoin mining, and, we ourselves, we produce data centers in certain instances, we work with them. So it just depends on the use case. And then lastly, equally, Core Scientific is actually a good example where they still do some Bitcoin mining. And
Right.
you're actually starting to see some data centers where the way they build out the actual infrastructure, like the racks and for the machines themselves, you can have some where they're doing both AI mining and BTC mining. And so it's you get a mix of both. And it's a good way to diversify, your portfolio and your risk, at least from a data center perspective. So yes, there's certainly a battle, but it's not a case that AI's come here and now Bitcoin's going to suddenly disappear. No, definitely not. I think
Never.
because, yeah, exactly. I personally think Bitcoin will last longer, but no, I think and that's just because Bitcoin can mine in locations AI cannot, and the initial capex is smaller. So yeah, I think they'll complement, but it's just the initial rush, kind of has been going to AI versus Bitcoin mining probably in the last couple of years.
As technology evolves, so does the demand for energy. In the US, a new battle is unfolding over this scarce resource. On one side, Bitcoin miners, flexible, decentralized, and resilient. On the other, AI hyperscalers, massive, power-hungry, and backed by deep capital. This isn't just a competition for electricity. It's a clash of priorities. AI is seen as strategically critical, while Bitcoin mining still carries a reputation that varies across jurisdictions. But what does this mean for the future of mining? And how are miners adapting to this new reality? Let's explore.
In the very early days of Bitcoin mining, it was individuals such as you and I mining. You could technically mine on your laptop, and then slowly.
I wish it was me.
Indeed, I think those days are long gone. I wish I was
Yes.
mining that early, but no, at the time it was CPU mining was relatively easy to do. Then, as more and more people started mining, more sophisticated, dedicated ways of mining, were developed. So you went
Yeah, the
from
PC
CPU.
fans are not going to cut it today.
PC fans are not going to cut. Absolutely no. Yeah, like super early days was like CPU, then you had GPU, then you had the dedicated mining machines, otherwise known as ASICs. And then, as you can imagine, as Bitcoin grew and the value of Bitcoin grew, the mining sector, which produces, raw virgin Bitcoin and is required to power the whole network, grew in kind. And so you went from like hobbyists to like small companies to now large institutions, publicly listed companies such as Marathon that are worth billions and billions of dollars. And so, as you can imagine, as more and more participants enter the industry, you need to start thinking slightly differently. And so now mining has really matured into, what I call a balance sheet business. It's no longer simple enough to just plug in your machine and hope that the Bitcoin price, will continue to grow and cover your costs. No, now we're seeing operators increasingly acting like energy companies with hedging desks where they're actively managing their risk. And so a good example is where you see BTC-backed loans. So that's basically where miners are borrowing against their reserves of Bitcoin to cover their expenses and fund their expansions. Now that has a couple of interesting benefits. One is it doesn't trigger in certain instances certain taxable events, which is always good. No one's going to complain about
Always good.
reducing your tax burden. And then secondly, it stops you needing to sell off your strategic reserve. And then also, you have more broader, like more structured products such as, convertible notes, vendor financing, equipment loans, cash flows, all sorts of different things. Marathon just did a 700 million convertible bond, which is a good public example of that model.
Right. Okay. So that's great because I know there are many companies that are now working to do exactly that, to create opportunities for people to not have to sell their crypto in order to meet their expenses, especially when, we're all waiting for that next all-time high, hopefully happening in 2025 before the cycle's over. Yeah, that makes a lot of sense. So for a bit of a broader perspective, do you see this financial sophistication as a sign of the industry maturing, or do you see it more as a necessity for miners to survive in an increasingly competitive landscape?
Honestly, it's a bit of both. I think one, as the demand for mining increases, more participants enter the market. Historically, if I take a step back, ultimately, when it comes to Bitcoin mining, everyone is mining for a piece of the pie. There's always a finite amount of Bitcoin that is mined at, on each block. And then you have the halving and that reduces. It isn't a case that, hey, if you have more miners mining, then there's more Bitcoin to go around. No, it's the same amount of Bitcoin. And so what tends to happen is you see a very standard demand and supply mechanic in that if the price of Bitcoin is high, energy costs are low, etc., then more miners will enter the market, turn on their machines, and then to generate a profit. But as that happens, you can imagine there's that same amount of Bitcoin, but now it's been distributed amongst more miners. And so, you who may have been mining yesterday are now going to suddenly receive a smaller portion. And so when that
Ugh,
happens,
not again.
not again, but ultimately, what that results in though is that, it's almost survival of the fittest, I'd say, because the miners that aren't operating as efficiently, who have high costs, they get shaken out of the market because, the mine Bitcoin isn't covering their costs. And so when they leave, the number of miners reduces, and so those that are left start generating more Bitcoin. So it's constantly kind of going up and down, and you kind of see that with what is known as the network hash rate, which over the long term has exponentially grown. But if you kind of zoom in a little, it tends to be quite volatile, and it's based on like factors such as that.
Right. And this reminds me of early 2023 when Bitcoin was at like $17,000. And there were all these stories about how Bitcoin miners were literally just creating their budgets and saying, well, it's not really worth it if Bitcoin is 17K and I live in a place like Texas where the power grid is charging me $1 million to run my AC, right? So do you see the ecosystem that we're in now kind of allowing miners to make different decisions? Because I'm thinking if I was able to, lend against my Bitcoin and get the 17K Bitcoin 2.5 years ago, and then it hits 120, that looks like a good investment to me if you're able to be, a long-term investor there.
Absolutely. So you're completely correct. And actually, when that happened, that's where you saw a lot of miners exiting the scene or even pivoting. One of the reasons core science, or at least, if you follow the news, that core scientific pivoted to AI was that, when the bear occurred in Bitcoin, their operating costs, were high and they couldn't cover. And so they were actually quite close to potentially exiting. Fortunately, they kind of pivoted and it worked out very well. Now, what's happened since then is, to the earlier point, is you're seeing more financial products come out and ways to manage that risk or manage those costs. And so, as an example, you have things like hash rate forwards that allows you to kind of hedge your exposure. That, hey, if the hash rate goes up or down, then if you have a forward in place, then you can kind of hedge some of that, that downside. So, you're seeing more sophisticated, treasury management, such as using, loaning out Bitcoin to generate yield, or you could have like energy contracts that are a little bit more dynamic. So yeah, there are a number of different ways to do that compared to what there were previously. And it's partly because these more sophisticated financial products now exist, but also, the miners have become more developed, more industrial, more sophisticated, that they're able to deploy that, whereas previously they may not have had that experience. Or maybe they were just like way too long direction or bullish and they didn't necessarily think too much around, hey, what happens if you have this big pullback and you don't manage that, that risk. So it's always good to have a reserve to cover things like that.
Absolutely.
The PR Genius is a top crypto PR and growth marketing agency, helping brands globally with expert PR and strategic growth marketing. They've worked with 300 plus projects like Movement Labs and IO.net. Unlike traditional agencies, they charge only on performance. Their services include earned PR opportunities and marketing services to help boost wallet holders and organic X followers. Learn more at www.theprgenius.com.
For years, the US has been the epicenter of Bitcoin mining, thanks to its abundant energy resources and regulatory clarity. But the tides are shifting. As energy costs rise and competition intensifies, miners are looking to new frontiers. Latin America and Africa are emerging as key players, offering untapped energy potential and favorable conditions for mining. So will the US lose its dominance? Let's find out.
So right now, I think the US accounts for about 35% of the global hash rate, which is a huge share if you think about it. And especially if you actually consider how quickly that grew versus, when China actually banned mining in what was it, 2021? Back then, they were the largest. And so, there's a number of different reasons we saw that growth. Partly it was, strong state level support, easy access to capital. There was a little bit more regulatory clarity, and it was just a natural home for like large scale miners. But going back to, the AI side and in general, energy economics are shifting the center of gravity. And so in some parts of the US, energy is becoming more expensive, or mining is becoming a lot more competitive, that you need to, continue finding ways to keep your energy or your production costs low. So it isn't, just pure energy to power the machines. You also need energy to keep the machines cool, to run the data centers, etc. And so you have other locations that are equally, trying to get in on the action. Some at the state level, some at the government level, etc. Latin America is a great example. You have, we've seen it in El Salvador, Paraguay. So El Salvador has geothermal. Paraguay has a lot of hydro. Argentina has stranded gas, similar to Brazil, which has huge renewable capacity. And then equally, even in Africa, you've got places like Ethiopia with hydro, with geothermal, and even in the MENA region. And so, miners will generally go where you can mine at a very efficient cost, and energy is the single largest driver of your cost. Now, as long as the miner can, one, get comfortable with, the regulatory landscape in the country being a safe place, getting the right government support, etc., then, they will go there. But it doesn't mean that we're suddenly going to see like people leaving the US. No, absolutely not. Really, it's about diversification. I'd also say, you don't necessarily want 100% of all your mining operations to be in a single location. Let's just take the US for argument's sake. You don't want to be exposed to like the US regulator or the US power market. It's always a good idea to diversify. And actually, even us at GoMining, we mine all around the world, including in, South Africa, Africa, Scandinavia, the MENA region. But we also heavily mine in North America. And actually, that's our strategic focus, to expand there. Why? Because it has currently the strongest policy tailwinds, state level support, everything's going well in the US when it comes to Bitcoin and Bitcoin mining. I think that's fairly evident to see.
Yeah, and you wouldn't keep all your crypto in one wallet.
That's a great analogy. There you go.
Might as well put everything, you're mining across the world as well. It makes sense. Best practices apply.
Very good.
So we're talking here about, energy costs and regulatory environments being two key drivers to miners making these decisions. Would you say that those are equal considerations, or is one kind of weighing more heavily than the other?
I think energy will always be single biggest. It accounts for a huge chunk of mining overhead. Regulatory obviously is important. There's been take China as an example. It was the largest mining location for several years.
Right.
But then the government banned it, and they kept banning and banning. Yes, the regulatory space is important. Now, having said that, it's actually not that difficult for a miner to almost pack up and then leave and start mining in another location. So actually what happened was, when China banned, there was a huge influx into Eastern Europe, specifically Kazakhstan, where people were mining. The government was very welcoming. The hash rate, it dipped, went up, and there's loads of miners. But then that country, changed its mind a little bit, and not as many people are mining there. If I take Ethiopia as an example, great place to mine, hydropower, but actually, one of the local energy suppliers, probably took on more than they could in terms of like mining contracts. And so they're now saying, actually, no, there's too much load on our grid, so we're not going to take any new ones. Now, with the US, you'd be surprised, but there's a huge abundance of energy sources, particularly for mining in the US, and it's very cheap, which is why the US is like almost the ideal place, because you have strong reputation, you have a strong regulatory landscape, you have a strong state support, and the energy costs themselves are actually like very, very competitive. Think of West Texas, etc.
Right. Okay. Interesting. Because I wanted to ask you if you see a world in which the US loses its dominance for Bitcoin mining, but it sounds like you think we might be able to adapt.
Yeah, I think no, not for a while longer, unless something dramatically shifts. Now, why do I think that? The Trump administration example is like very pro-crypto, very pro-crypto mining. I mean, only yesterday, American Bitcoin IPO'd, which is basically partly owned by the Trump family, as well as Hut 8, and they merged with Griffin. But that IPO itself, was actually very successful. it went up over 100%. I think it settled on around like 17% higher. But, when you see things like that, you see the strategic Bitcoin reserve being signed off, you see things like executive orders to allow 401k to get exposure to Bitcoin, then, there's all the right signals there. So I don't see it changing. The only thing that could, in my personal opinion, result in maybe the US losing some of its dominance would be if China opened up again and they said, actually, you know what, we're going to allow people to mine Bitcoin, because China has historically been a very, very cheap place to mine. It's just the government stopped allowing it. So I would say that's probably the only risk to US dominance in the Bitcoin mining space.
Why is it always China? Bitcoin's journey from a niche experiment to a global asset has been nothing short of remarkable. And now we're entering a new phase, one defined by institutional and sovereign adoption. With $100 billion in ETF assets under management, new corporate accounting rules, and even sovereign reserves forming, Bitcoin is no longer just a speculative asset. It's becoming a strategic reserve, a portfolio diversifier, and a hedge against inflation. But what does this mean for an ecosystem built on a story of being anti-establishment? Let's dive into the signals that are redefining the narrative.
Our view is that these are some of the clearest signals yet that Bitcoin is moving into a new phase of adoption. As you said, on the institutional side, ETFs have been a big game changer. Spot Bitcoin ETFs now hold over 100 billion. I think it's almost 150 million in AUM. The actual cumulative transactional volume surpassed 1 trillion by mid-year. It's been probably it's literally the fastest growing ETF of all time. Highly, highly profitable for BlackRock, for the IBIT one specifically. And what's so good about it is that it makes Bitcoin accessible to investors through the same rails that they have for equities and bonds. And that's actually historically been one of the reasons why it's been quite hard, at least for more TradFi-esque investors to get into Bitcoin, is they weren't comfortable in how you get exposure to it. Maybe they felt that some of the exchanges that offered it weren't mature enough. They weren't comfortable with self-custodying, etc., etc. ETFs just makes it super easy. And also ETFs allow a lot of individuals, companies, etc., to get exposure to Bitcoin because, ETFs have already been signed off, say, as an example, within their mandate. It's not a new exotic product. Now, in addition to that, we just saw President Trump. He signed the executive order that allowed Americans to allocate a portion of their 401k retirement system into Bitcoin. Like it's going to happen. I don't think you realize how big that portfolio is. We're talking about almost 9 trillion, is the value of 401ks right now. So imagine if just a tiny bit went towards Bitcoin. Not saying it will, but that's the sort of market size we're seeing. Also, you've got the Bitcoin reserves. You're seeing a huge explosion in Bitcoin treasury companies. You've got Strategy. They just surpassed 600,000 BTC, 3% of the total supply. On the US Treasury side, they've got almost 200,000 Bitcoin in reserves. And then you've got dedicated specific companies just saying, hey, we're going to add Bitcoin to our balance sheet. It's a great diversifier for them in terms of currency, inflation, etc. And so, if you look historically at new financial products or asset classes, as soon as the institutions, Wall Street, whether you hate them or not, when they enter, things tend to happen very quickly.
And, they like when numbers go up. So if they're going to help us crypto OGs, enjoy a little bit more success, I'm kind of okay with that.
Indeed.
And so you just mentioned a whole bunch of institutional adoption, and I'd love to hear your thoughts on how you think this will affect the Bitcoin ecosystem. Do you think it's going to bring more stability, or do you see any risks that this can bring?
Yeah, I think there's both, and I think everyone should consider that. So, I'd say the implications are probably twofold. On one hand, typically large institutions and even sovereigns, they tend to be long-term holders of assets. And so being a long-term holder of Bitcoin, should add stability to the market. However, on the flip side, by introducing deeper financialization into Bitcoin, and it could result in it being tied to more macro cycles and regulation. My view is that look, overall the signal's clear. Like Bitcoin has graduated from being a speculative asset to being recognized as both a strategic reserve and a mainstream portfolio diversifier. Where I have some personal concern is the rise of the Bitcoin treasury companies. Like it's great, it's good to see. Strategy is a good example. But if too many companies do it without really understanding the risks and knowing how to do it operationally, could create you know, it could create a structural risk in that. Let's take an extreme. Imagine if strategy suddenly blew up, that would have a huge impact on the Bitcoin price. And so they're led by like some very smart thinkers, and the way they're structuring is actually quite impressive. But, if you have any single institution or individual that accumulates too much Bitcoin and something goes wrong, then you can only imagine there'll be a big knock-on impact. So yeah, what I'd say is anyone that's looking to become a Bitcoin treasury, add it to your balance sheet, just make sure you do your, DYOR, as we say, do your research, understand the risk, learn how to manage the risk, etc., like any other financial asset, and then hopefully we'll all be okay.
Yeah, and so that brings me to my next point, which is a lot of sovereign actors, governments and even universities and, companies included, who are creating Bitcoin reserves. Could this change the narrative around Bitcoin at all as a global asset?
No, I don't think so. It depends on your view of Bitcoin. So, I'd be interested to get your view. Like, is your view that Bitcoin is more like digital gold and it's a store of value and you hold it and you don't do anything with it? Or do you see it more as, what Satoshi initially envisaged was it's a replacement form of cash or fiat, and so actually will be used day to day in transactional markets, etc.?
I think right now, because of the price volatility, I personally use it more as an investment tool, kind of banking on the idea that it's going to continue to rise. And for that reason, I don't spend Bitcoin on anything. The flip side of that is, I'm an NFT maxi. I have spent insert figure here of Ethereum on digital art, right? Yeah, I'd be embarrassed to say. I think just in the current market, for me, I don't see Bitcoin as something that I'm willing to part with. But as it continues to, stabilize and be less volatile, I could definitely see it being something that we spend. But I think, for me, that's the question of, my gut reaction would be I'd rather spend my Solana or my Tezos or my Ethereum rather than my Bitcoin.
Yeah. So, if that's the case, and I think that's what the majority believe, then more companies purchasing Bitcoin and adding it to their balance sheet, and most are adding it to their balance sheet for twofold reasons. One is they think it'll potentially grow, or two, is acting as a portfolio diversifier, and it's also acting as a good inflation hedge. So from that aspect, then it's only a good thing because you're getting more people participating in Bitcoin. It will result in it becoming more stable. As you can imagine, demanding increases for something that has a fixed supply. Will its value go up? Most likely. We just had, who was it? We had Eric Trump that came out and said he thinks Bitcoin's going to hit $1 million by 2030. You had Brian Armstrong, the CEO of Coinbase, who said the same. His insights were really interesting because he said, look, Coinbase, yes, is predominantly a retail platform, but actually we serve a lot of institutions and a lot of states and governments around the world, and they're very interested in acquiring Bitcoin. And based on like what he's seeing, it wouldn't surprise him if the value of Bitcoin went up to like almost $1 million by 2030, which would be phenomenal, of course.
That works for me.
Exactly. So I think for now, it's probably a good thing. I think not any sort of adoption is good, especially in the early days. And we need the institutions and we need larger capital allocators to come in to help drive Bitcoin. Now that doesn't mean that you just have people that hold Bitcoin. You have people that are building on Bitcoin. You have the Lightning Network. You have many layer twos. You have ordinals. You have ruins. So like, as you have more and more of these companies or projects that come and build on Bitcoin, then that's great because it'll increase demand, activity, transaction fees on the network. So no, I think it's, right now, at least it's driving momentum in the right direction.
Okay. And so I have a little bit of a conspiracy theory question to ask you.
Okay.
So great segue. I've been seeing headlines for the last 6 to 12 months about different governments buying up tons of Bitcoin, BlackRock, and now lots of banks also getting in. Do you see any threat, like if there's a world in which all these giant institutions and then Bitcoin whales own all of the Bitcoin? And like, where does that leave retail investors? You know, the 25-year-old grad student who wants to buy $10 of Bitcoin on Coinbase. I mean, do you see any like potential issues there with people locking up Bitcoin onto their balance sheets? Like, is there any possibility where it could become less liquid than it is now?
No, I think it'll be quite the opposite, because what's good is, you kind of said it yourself. If you want to buy $10 of Bitcoin, you can buy $10 of Bitcoin. It isn't a case of you have to wait for Bitcoin to drop to $10, because you can buy Bitcoin in increments, in Satoshis. And so you will always be able to buy $10 of Bitcoin. I would compare it to, say, gold. So the majority of gold is actually held by reserves or states, etc., that lock it in their vaults and
right,
do whatever they do with it. That doesn't mean that you and I cannot go and
build little houses with the blocks.
Little houses of gold. But look, that doesn't stop, you and I going out and buying gold. If you want to buy a gold bar, it's relatively easy to do. If you want to buy jewelry that's made from gold, it's possible to do. I see Bitcoin in that same manner. Sure, you might get a portion that is locked away, but that's not going to stop, the remainder being liquid on exchanges, the market. What will actually happen is that, let's say if that happens, the price of Bitcoin will probably go up. And it just means that, when you want to buy your $20 worth of Bitcoin, it's a smaller amount than let's say it would be right now. So that's kind of the way I think about it.
Okay, so you're saying I can rest easy.
Rest easy. And if you already hold that Bitcoin, then you're okay.
That's the goal for now. At the heart of this story is transformation. Bitcoin mining is no longer just about producing digital currency. It's becoming a global infrastructure industry. This transformation is being driven by three forces: the competition with AI for energy, the rise of financial engineering among miners, and the growing adoption of Bitcoin by institutions and sovereigns. Together, these forces are reshaping the industry and setting the stage for what could be a golden age of mining. But what does this mean for the next 5 years? Let's zoom out and look at the big picture. To start wrapping up, if you had to sum up the next 5 years of Bitcoin mining in one sentence, what would it be?
In one sentence, I would say that Bitcoin mining is transforming from a niche compute activity into a global infrastructure industry. Like, what does that mean? If you let me elaborate just a little bit.
You may footnote your sentence, absolutely.
Okay, perfect. I will now footnote it with a whole paragraph.
You can now unpack it, yes.
Yeah. Broadly speaking, there's like three forces that are driving the shift. There's the competition with AI for megawatts. Secondly, there's the rise of financial engineering with how miners manage their balance sheets, etc. And then thirdly, you've got the institutional and sovereign adoption, spot ETFs, 401ks, reserves, etc. So for investors, including retail, this means like mining is not only directional Bitcoin exposure, but increasingly an energy-backed yield play with efficiency and reinvestment driving returns. So what does that mean for policymakers? It means that they need to recognize that mining is a flexible load that can stabilize grids. It can monetize underutilized power. And then for miners, I personally think for the next 5 years, it's all going to be about efficiency, geographic diversification, financial resilience, based on the demand and the need for Bitcoin. At the end of the day, the miners power the whole network. If all the miners turned off their machines, there is no Bitcoin anymore. The Bitcoin miners will always be needed. And I think, we're actually entering a new golden age of Bitcoin mining, probably for the next 5 to 10 years, because it's becoming a lot more and there's a lot more opportunity, regardless of what we're seeing on the AI side.
Right. Okay. And so you kind of answered my last question, but let's just dive in anyway to be super thorough. What should miners, investors, and policymakers be paying attention to as these trends that we've discussed this whole episode continue to unfold?
Yeah. So I think for miners, it's continue to think about your costs. So energy costs, but not just energy, what are other ways you can reduce your overall costs? So things like, working with local energy providers on things like, paybacks in terms of like giving back energy, curtailment, how can you reuse power? We're starting to see that. How can you reduce your costs to mine in terms of like cooling your machines? Obviously, what we're seeing right now is, the vast majority of miners are operating on the Antminer S30%. A lot of them are now transitioning to the S21s, which are a lot more energy efficient. So again, you have that large upfront cost, but it means you'll be mining more efficiently. But we're already moving into the S23, which is even more efficient. So miners are at that point in time where they're now starting to upgrade. I think for policymakers is, do what the US is doing, embrace Bitcoin mining, because if you believe in Bitcoin and you want to support the Bitcoin ecosystem, then support the miners, because we really underpin the ecosystem and we are the backbone of mining. And so help us in terms of like how can we work with you, with the states, to complement local power needs, demands, offer us the incentives that we need. And then in terms of investors, what we're seeing is that ETFs evidence the institutional demand and appetite for Bitcoin. And so now investors are looking at, okay, what are the yield? How else can I get exposure yield on Bitcoin? And so one way could potentially be through mining. So either mining yourself, public miners, hosted, private, tokenized mining, which is kind of what we do. It could be like more exotic derivative products, structured financial products, many, many different ways. To someone that's interested in Bitcoin, do your research. There's many ways of getting exposure to Bitcoin, and it isn't as simply as going on Coinbase and purchasing Bitcoin. There's different ways of doing it, and there are, in certain instances, ways of getting it at a more efficient, cheaper way, potentially.
Right. Wow. All right. This all sounds great. Fakhul, thank you so much for spending part of your day with us here at the Defiant. I really encourage everyone listening to go check out the H1 2025 Bitcoin marketing report, because we really just scratched the surface here. Wouldn't you agree?
Yeah, definitely. No, thank you for having me. The H1 20 report, it was very important for us to do. It was actually the second institutional report we published this year. Our first one was actually the history of mining. So if anyone that's new to mining or wants to learn more, definitely come and check out our socials. So institutional.gomining.com, where we publish all of our reports. It's easily accessible. Our first report covered like the entire history of mining, how it grew, why it grew, what the different factors were. And then the H1 report was basically to give a comprehensive overview of the Bitcoin mining industry as it is right now. What are the important factors, what's driving it, and what's coming next. So yeah, no, it was a pleasure. A lot of blood, sweat, and tears went into it, but it's worth it, and we feel it's very valuable intelligence for readers.
I'm sure all of the academics in the audience are waiting with bated breath. And is there anything else coming from GoMining that our viewers can look forward to?
Yeah, definitely. At least on the GoMining institutional side, we publish a lot of thought leadership. So, we do monthly market analysis. We always do an evergreen article. Quarterly, we do reports such as this one. So our next one will be coming out towards the early October.
Wonderful. All right, Fakhul, thank you so much for joining us, and we'll be keeping tabs on what y'all are working on and how you can help everybody educate themselves on this very interesting and fast-moving part of the ecosystem.
So thank you so much. It's a pleasure being here. Thank you, Vinny.
And I'll see you in London.
Indeed, yes. Or I'll see you in New York.
One or the other. Why choose? That brings us to the end of today's episode. A huge thank you to Fakhul Miah for sharing his insights and helping us navigate the complex, ever-evolving world of Bitcoin mining. If you're curious to learn more, I highly recommend checking out GoMining's H1 2025 Bitcoin mining market review. It's packed with valuable insights and a must-read for anyone interested in the future of this industry. As always, thank you for tuning in to the Defiant Podcast. Don't forget to subscribe, share, and leave us a review. And join us next week when we'll be talking to Reeves Collins, co-founder of Tether and the programmable NFT platform BlockV, about his experience building Web3 infrastructure and his passion for democratizing access to finance through decentralized systems. But until next time, stay tuned, stay informed, stay defiant.